Okay, it is January 16th, 2026. And looking at the markets this morning, I honestly feel like we stepped into some kind of malfunctioning time machine.
It's a polycrisis, right? That's the buzzword.
Absolutely. We're seeing warning signs that look like, I don't know, 1970s stagflation just got matched up with the 1999 dot-com bubble. It is chaotic out there.
It is. But we aren't just guessing today. We're unpacking a really heavy-hitting report that dropped this morning, the 2026 Financial Market Forecast.
Right, and this is from a Nobel laureate chief quant strategist, so we're talking about heavy math here.
Very heavy math, complex simulations, cycle theory, the works.
So the mission for this deep dive is to cut through all that noise. We want to answer two massive questions for you looking at the rest of the year through December 31st. First, is the AI party actually over?
And second, how is this political chaos, specifically in the U.S., going to reshape your money across global markets, from New York all the way to Seoul?
Okay, let's start with the big one, AI. Because for everyone who's been riding that wave, this report is, well, it's flashing a massive warning signal for 2026.
They're calling it the Great Filter.
That sounds ominous. I mean, a filter usually removes the junk, but you're talking about a market crash.
A likely one, yeah. They ran a Monte Carlo simulation. So they basically used an algorithm to play out the year 100,000 different times.
100,000 times, wow.
And the result, a 68.4% probability of a crash. A crash greater than 20% in AI stocks by Q3 or Q4 of this year.
68%. That just feels incredibly high given how much big tech is still pouring into the sector. What's breaking the model?
It comes down to a concept called swarm stupidity.
Swarm stupidity.
Right, coined by Gunter Dueck. It's this idea that really smart individuals, when they act as a herd out of, FOMO.
They create a stupid collective outcome.
Exactly. Big tech is spending over $500 billion on infrastructure, but the efficiency gains just aren't appearing fast enough to justify it.
Is there any actual proof of that? Or is it still just a theory?
Well, the report points directly to OpenAI introducing ads to ChatGPT. Think about it. If the tech was just printing money on its own, you wouldn't need to annoy your users with ads.
That's a great point. It just screams profit pressure. The cash burn is hurting.
And the moat, that competitive advantage, is drying up. The CEO of Google DeepMind just admitted China is only months behind the West.
So if everyone has the tech, then nobody has that scarcity premium anymore.
And the model predicts a very harsh reality check because of it.
Okay, let's pivot to the bigger financial picture then. The U.S. market usually anchors everything, but right now the vibe between the incoming Trump administration and the Fed feels hostile.
It's what the report calls the institutional crisis. You have talk of nominating loyalists like Kevin Hassett to the Fed. That directly threatens its independence. Fitch has already warned this could hit U.S. credit ratings.
So if the referee's wearing one team's jersey, the whole game just breaks down. What does that mean for the numbers?
It connects to Seyfedin Amis's theory of capital destruction. When politics erode the dollar's value, investors demand higher returns to hold U.S. debt. Larry Fink is predicting 10-year Treasury yields could hit 5, maybe 5.5%.
Which is incredibly high. And for the stock market, the S&P.
The prediction is that it gets stuck in a box. Somewhere between 4,200 and 4,800, the upside is capped by rates, the downside is cushioned by inflation. It's a grinder.
Okay, so if the U.S. is a grinder, how's the rest of the world doing? You said China's taking a completely different approach.
It's fascinating. While the U.S. is volatile, China's engineering what they call a controlled slow bull. They've cracked down hard on high-frequency trading.
The algorithms that trade in milliseconds.
Gone. They've raised margin requirements to 100%.
So you have to buy with real money. You're banning the casino element.
Exactly. They are trying to kill speculation.
Yeah.
And they've formed a strategic partnership with Canada to lower EV tariffs. They're playing a very long game.
And what about Korea? It's always the canary in the coal mine for global trade.
The report calls it the nutcracker crisis. Picture it. One arm is U.S. tariffs, the other is Chinese supply flooding the market. Korea is the nut being squeezed in the middle.
Ouch.
Yeah. The model suggests the one is going to be structurally weaker against the dollar, sitting somewhere between 1,400 and 1,500 for the year.
That's a tough spot. And Europe?
Stuck. It's a stagflation trap. Gas prices are back up to €35 per megawatt hour, but German inflation is dipping. It makes it almost impossible for the ECB to set a coherent policy.
So if we pull all this together, you've got AI hitting a reality check, U.S. institutions fighting, and the global market just fragmenting.
The theme for 2026 is pretty clear.
Yeah.
It's political insanity overriding economic rationality.
So what's the move for the listener here? How do you navigate insanity?
The takeaway is Ken Fisher's advice. Cash flow is king. You need to ignore the dream ratios, like price to sales, and look for the hard numbers, price to earnings.
If a company isn't making real profit now...
It might not survive the winter.
And speaking of winter, we have one final thought to leave you with.
You should consider Edward R. Dewey's cycle theory. We're exactly 54 years past the start of the 1970s inflation. Dewey's model suggests we might be entering a long economic winter.
In that kind of environment.
In that environment, paper assets tend to struggle, and only real assets, think things like gold, tend to survive.
A cheery thought to end on. Check your portfolio, watch the cash flow, and buckle up. Thanks for listening to The Deep Dive.